Welcome to episode 234 of The Numbers Game. I'm Jace. I'm here with Nick and Marty. And guys, today I want to talk about why it's critical for your business owners to do tax planning. Tax planning sounds boring. It's not that exciting. Doesn't sound sexy. But I'm hoping that by the end of this ep, you guys will absolutely be in agreement with me that tax planning is one of the most crucial things a business owner can do. To get you guys involved, when I say tax planning, what do you think of, Marty?
Well, I'm thinking, are you going to save me money or make me money or do a bit of both? That's where my head's going.
Yeah, awesome. Hopefully a bit of both. Depends what kind of year you had and then what your future plans are. But yeah, no, good start. What about you, Nick?
I'm planning on playing the ATO minimal.
Oh, okay. Legally, the legal minimum amount of tax payable.
Well, it depends on your accountant, but if I came to future advisory, it'd be all above board, yes.
Oh, God, don't even get me started on that. Some of the things that we see that come, I love the accounting profession. I do a lot of work with the CPA and Xero, but sometimes you come across something and go, this is just really not up to scratch and not the standard that should be out there. But anyway, I thought it'd be timely to drop this. At the moment, if anyone's catching this in the more timely of when the episode comes out week to week, it's going to be early June 2025. It's not giving you much time, but it's tax planning time. So if you haven't already met with your accountant, there's a whole list of things that business owners should do before 30 June. Now, if you're not doing it before 30 June, you're often giving yourself or opening yourself up to a bit of risk that the ATO come knocking and you didn't have the documents in place by 30 June, there's risk. If you haven't done your trust distribution resolutions by 30 June, there's risk. And I'm happy to kind of touch on a few of those points with you guys today to explain that. But ultimately, if your accountant is worth their weight in gold, they would have offered you a meeting before 30 June, or they've already got you set up in this system of declaring dividends, doing your trust distribution minutes, talking to you about bucket companies and family trusts and all those things. But I kind of wanted to get into, especially off the back of 2025 as a financial year, has been a bit of a turbulent one, I'd say. I think there's a lot of businesses doing it tough out there. So even though we're talking about tax minimization and not paying the right amount of, not paying too much tax, there's also opportunities to get in a room and help business owners out when you talk about not just minimizing tax, but also the strategy of how their business is being ran moving forward. I guess when you look at proactive relationship with your accountant, you don't want to just be looking at historical numbers, planning for the past. You want to be using the numbers to plan for the future. So I guess, throwing it back to you guys again, conversations with your accountants in the past, has it felt reactive or kind of looking at past numbers, or is there a fair bit of forward planning as to what's coming ahead for your business?
Reactive for me and my clients. Yeah. Which is why it's super important to take responsibility yourself.
Yep.
Yeah, I've been fortunate a few times, I say a few times, where I've got a call in advance and on something that's coming up that's actually quite good that I didn't know about. They're the calls I really appreciate. Like I go, when an accountant does that, it's like it's setting you up, for the next year. But it's not that common. It's not that common that you see that out there.
Yep. Awesome. It's a good point, Nick. And actually, I want to circle back to that. You said you have to take responsibility. Now, as a director of a company or the trustee of a family trust or a combination of both, the ultimate person responsible to make sure things are lodged on time, lodged correctly, and done all by the due dates is the director and the trustee of the trust. So it's all good and well that if your accountant's busy, hasn't been able to be proactive, some businesses are doing it tough. I mean, we've recently just hired, I think, 5 people in the last 5 weeks because we needed to increase our capacity to ensure that we can continue to serve the business owners that we work with and serve them well and provide value. But I can imagine that not everybody has the lead gen of employees and the attractiveness of a model that Future Advisory's built over the years. So there's probably some firms out there doing it tough. So why it's important to touch on taking responsibility is if you're a business owner and you haven't heard from your accountant, it's also okay for you to pick up the phone and look for that service and try and book in and bring yourself back to the top of the list. It's also your responsibility. If your accountant can't take after you anymore, you've got to go and find somebody else who will look after you. So great point to make up front, Nick. Now, why this matters off the get-go, I mean, I'm immersed in this information, but there's an example of a case the ATO are fighting at the moment called the Bendel case, and that's to do with how distributions were basically sent out to a bucket company and loaned out to members of the family. There's trust reform over the years, things called Section 100A, and I'll try not to bore you with all the stuff, but it's important, again, this taking responsibility that if your accountant talked to you about doing a family trust distribution to your partner, your kids, your mum or dad, but the money never moved hands, you're at risk there that if the ATO comes back and audits you and has a look and says, well, hang on a minute, you declared 50 grand of income into so-and-so's name and they paid less tax than what you would have. So that's tax avoidance if it's not done properly. If you didn't move the money physically as part of the trust distribution, you could get yourself into some hot water that basically it's just a scheme to do tax avoidance rather than genuine tax planning for family tax minimization.
I think if there's no point having the strategy if you're not going to implement the logistics in the strategy, so it's I understand why they might be looking into that.
Beyond that, the ATO have also increased their reporting ability. So what happens is now when an accountant lodges a family trust return, if I said through my family trust that I was declaring some income into my wife's name, so Casey's going to get a family trust distribution, the data matching will now register that on Casey's pre-fill report moving forward. So when Casey goes and does her tax return, if I didn't tell her that I was doing a trust distribution to her tax return, it's going to pop up on her pre-fill report and automatically add to her tax return, which can then all of a sudden cause some awkward conversations if people aren't being fully transparent with their partners, siblings, parents, or adult children. So again, this communication up front and pre-30 June is really important because otherwise if you decide to do it, trustee signs off on it, tax return gets lodged, but you never had the conversation with adult children or partners or family members. When they go to do their tax next year, it's going to be on their pre-fill report and they're going to be asking some questions. Go, how did this get there? Who was responsible? And this is the first year this is going to be happening, that the pre-fill report will include trust distributions from family trusts.
The other thing there too, Jace, is it could impact next year's PAYG income, where if you I'm just thinking if you distribute and someone gets a tax debt, which they would if you distributed generally, and they'll have a tax bill, then next year they'll possibly have to prepay their PAYG based on that last year's income.
Nick, it's almost like you know how to time these things beautifully.
Possibly been there, done that.
And it flows into cash flow is king is the next little part of this. So when you're thinking about tax planning, one thing that clients love to know is what cash is mine. So you might be looking at your company bank account, there might be 100 grand in there. But if you don't do tax planning and you get to November and I send you a $30,000 tax bill and a $50,000 BAS for the June quarter due the September quarter due 25th of November, and all of a sudden you've got your September BAS, your June BAS took a big chunk of cash and you got a $30,000 tax bill. So all of a sudden that 100 grand disappears, but you didn't know the tax bill was coming in advance. That's a pretty shocking way to, operate a business without knowing what your cash flow is. So the best part about tax planning is also what you touched on, Nick, is an understanding of your future cash flow events. What date the tax bill's due? What's an estimate of how much I owe? And then if there are distributions moving around through family members, what are their tax installments going to be? So you've got to be able to start to prepare for those in future, especially if you've had a bit of a turbulent year where you haven't been able to plan for that cash flow. So you want to avoid those last minute scrambles or the unnecessary stress of getting a bill in the mail that you weren't aware of. A lot of the conversations we're having, in April, May and June every year is that transparency with a client to say, hey, this is how much money your company made. If we do nothing and you're happy to leave the money in your company, your tax bill, let's call it $30,000, is due in May 2026. So in May 2025, you're being told a year in advance how much money is not your company's money and that you should be putting aside in your long-term tax savings, or making sure it becomes not part of your working capital. So ripping it out and sticking it in a high interest saver as an example of how to manage that money effectively.
Yeah, I can't tell you how much tax debt I've seen over the last 2 or 3 years with businesses. And one of the biggest destroyers of businesses is mismanagement and lack of understanding on cash flow. Like 100%, that's the main killer. So it's really great advice, because it's people need to hear it and understand it.
This is a question that I've had in the past. If you, particularly with people that are the 1 or 2 person bands, where they haven't got a big cost base, so most of what they're receiving is income for themselves.
Mm-hmm.
If they're putting tax away, you mentioned a high interest account.
Mm-hmm.
Does it need to be in, if they're an entity, in the entity name? If they're an individual, such as a sole trader that's registered for BAS, can it then be in something like a mortgage offset account?
Yep. So if you're a sole trader and your ABN's under your personal name, that money is effectively yours. So sitting in your offset is the version of the high interest savings account. So definitely, same with the family trust. Generally, if you're the beneficiary of the trust, that money is going to be yours at the end of the year. So if it's not sitting in the trust account, it sits in your offset account. That's a little bit easier if the money is going to flow to you. Because when you think about a family trust, you have to distribute all the profits of the family trust before 30 June. It has to be told who the beneficiaries are. If you don't do that, the family trust tax rate's 47%. So this is why getting those trust distributions done before 30 June is so crucial, because nobody wants to be hit with a 47% tax bill for not doing their job properly or not doing the distribution minutes.
Chase, a lot of business owners, rightly or wrongly, will take a loan out of the business across for personal use. What are the ramifications of doing that compared to, because technically they're seeing that as taking income that they've earned, right? Without understanding the consequences. What's the balance of that compared to trust distributions, and how do they differ? Just so people know.
So the difference with a family trust, if you're the individual beneficiary and the money's going to flow to you, that's becoming part of your drawings out of the trust, which becomes your taxable income at the end of the year. The difference with a company is that the company in its own legal entity, right, even though a trust is its own entity too, but there's beneficiaries that will pay the tax. As a company, if you're not formally distributing that money out, it's the company's money. If the director takes that money and parks it somewhere else, you may be setting up what's called a Division 7A loan, and that's something the ATO frowns upon pretty badly unless you set it up properly. So again, this whole idea of meeting your accountant before 30 June is to put the paperwork in place to keep you safe. If you did strip some money out of the company and use it somewhere else, you need to create a loan agreement for the amount you took, formal structured repayments to say, okay, I did take 100 grand, but I'm going to pay back X per year. And I know the interest rate, which is all dictated by the ATO. There's a specific interest rate you have to pay when you borrow money from your own company or take money from your own company. The flip side of that, again, is where people get it wrong. If they don't meet the minimum repayment, that whole amount can be declared as a dividend, and then it becomes taxable income in the person's name, which is what it should have been anyway. Because if they took the money with no intention of repaying it to the company, it should have been declared as income to that individual's personal tax return. And then it's their money. They can do what they want with it, but they're going to have to pay the difference between the company tax rate and what their individual marginal tax rate is in that particular year, which again is why when you do tax planning, you balance it out to say, well, actually, you've earned 130. You can earn up to 190, and it's a pretty efficient tax rate to 190 for the 2025 financial year. Let's declare a dividend and clean up that loan account so that you don't actually owe your company any money. Or the conversation goes, you've taken money out of the company, big no-no, put it back in before 30 June to avoid getting yourself in any trouble, or put it back in before lodgement date of your next tax return to avoid getting into any trouble.
So why do people take a loan out instead of a distribution? Like why would that? I know we've talked about it previously briefly, but
kicking the tax can down the road. So if you pull 100 grand out and do it and say you're going to repay it,
so you're not paying tax on it. That's the name of the game, is it?
Yeah, you're repaying it back to the company, and the company earns some interest and then pays tax on the interest, as opposed to if I took the 100 grand and my marginal tax rate was 45%.
Okay.
I take the 100, and then I've got to send another $20,000 to the ATO in my own name.
Yeah, I see where they're coming from then. Because I see business owners do it. I'm going, why would you do a loan? It just doesn't make sense.
Well, and it really becomes poor management of their money over. It can lead to poor management of money where you've got extra money in your account. You know, sometimes people see their company funds and their own money, and there's a bit of a blend of merging them together and go, oh, I've got this much money in the bank. But if that money gets spent personally, or you actually pay down your home loan and it's not a offset facility, for example, then you've got to redraw against it. There's complications again of meddling with company money in your personal accounts. So again, something that needs to be really well managed in that relationship with your advisor or your accountant.
Jace, I wouldn't mind just going a little bit deeper on the whole offset thing and parking your tax. And I think it's important because everything that you guys just spoke about then, the thing that I was hearing was, well, you need to get your structure right based on what you're trying to achieve in your business. So should you be a family trust? Should you be an entity? And I think if you're not growing a big business, then family trust could be the way to go. At least that's where your distributions go. I just did some quick calcs. And I think this is highly important for people to understand this. But hypothetically, if you parked away, if you had 50 grand sitting in a tax account that was there for when and if the ATO needed money at some stage, depending on your business how your business performed. If you had that sitting in a high interest saver account, at the moment, with rates at where they are, that you're probably going to get 4.5% to 5% in from a return point of view. So if you had 50 grand in one of those accounts at 5%, then you're going to get 25 grand in interest, 2.5 grand in interest for the year. Is that right? That's right.
Yep.
So let's just pick numbers again. If it's a 30% tax rate that you end up paying individually, which is probably standard for a lot of good business owners.
Yep. Good average.
Yep. You've made 2.5 grand. So you're going to lose 30% of that, which is get you down to what, 1,700 or something like that net. Does that sound about right?
Mm-hmm.
So if you had that money in an offset account, your home loan's probably at 6%. So your home loan's always going to be somewhere between 1 to 1.5% beyond what you could get in a deposit account. That's just how it works. So effectively, if you had that 50 grand sitting against your home loan, instead of earning 5% or 2.5K, you've saved 3 grand or 6% with no tax impact because it's a saving. So just having that money in the right account is possibly a $1,500 a year difference. And then it just compounds after that. Like some people might have 200 grand sitting in that account. So I think it's a significant thing to understand, and it can actually come into tax planning as well. Where are you parking that money? You've just got it at least have it in a high interest saver, not just in another trading account. And if you can, get it in an offset account if you have a mortgage debt, which most people do, let's be honest. So,
and this is, again, that really important understanding of your structures and whose money's whose and where it can actually sit. Because if the ATO saw a company pulling all the money out into an offset, then paying it back at the end of the year, it can be seen that the company missed out on particular earnings on that money. It's been used personally by a director to gain a benefit. So there's just always like ways to be careful and ways to formalize, anything that happens with money. Family trust, sole trader, much simpler to be able to send that money over to an offset account or park it in an offset compared to a company. So there's just things to look out for. Guys, based on, a few of the other things just to look over of what happens at tax planning before I kind of give you a bit of a look at the agenda. Growth and opportunity. So again, I talked about you don't want to just get into a meeting or look at your figures for the last year and go, okay, cool, I made this much money. This is the tax I owe. Thanks for my trust distribution minutes. Thanks for my dividend statement. See you later. The conversation then needs to turn to, well, what are the future plans? It's all good, but since we're in a room together, since we've got this opportunity, what is happening in the next financial year? What are your goals? What are you trying to achieve? Are you happy with the business, how it runs today? And sometimes there's some pretty confronting conversations, but it actually gives that business owner an opportunity to look at, 9, 10 or 11 months worth of work and say, you project out. What we do as part of it is projecting it out. So we'd go, based on projections, this financial year, you're going to have turned over this much and you're going to keep this much profit. And your combined family taxable income is number. Are you happy? Do you feel like this is representative of how hard you've worked or what you've built in your business? Are you getting enough of a return? Sometimes the conversation is, yep, great year. I'm really happy. Love to just rinse and repeat and do it again. Other times you identify with business owners, like what we've talked about in a previous episode about burnout and stress and wearing too many hats, is they're actually not happy with their business and they need to look at, how to restructure, how to minimize operations, how to increase things or change the way things are operating. So it's a great opportunity to then lead into how we can work with our clients in the following year or how we might refer that to different referral partners who can, dive deeper with our clients to uncover what's going wrong and what needs to happen moving forward.
I think you bring up a critical point there, Jace, because so many, and I'm talking about business owners because it's my genuine interest, but have strategic planning. They do future planning in regards to their business, have everything in play for the next 12 months, 3 months, however long, but they never decide what they want to do with their personal wealth side of things, and really put the same level of detail into that for their family as they do for the business. And I think that's why that type of discussion and having a holistic discussion around not only the business side, but also personally is paramount, because again, no point making money in one area if you're burning it in another. So again, actually to formulate a personal plan with a business plan is, I think, a critical component that gets missed a lot.
Yeah. Marty, I had a good conversation yesterday with a leader of a real estate sales team, and a lot of those agents were contractors. So trying to teach them on personal wealth. And one of the things that I said, the absolute first thing you should do, and this goes against tax planning and, minimizing tax, pay yourself a salary. Work out what you need to earn in your household to pay your mortgage, put food on the table, and put some money away to invest, because that means that money will come in every week or month. It means it'll have a super contribution attached to it, so your super will start building. That's a mistake I made, being a young business owner. Didn't pay myself a big enough wage, super fell behind. And you're forced to pay tax ongoing. So you get rid of some of the burden of getting to the end of the year and having this big tax bill. And it just creates a really good habit. And at the same time, it helps tax planning. I know we're sort of digressing a little bit here, but it just made me think of the conversation I had yesterday around, getting yourself paid. Robert Kiyosaki.
Yep.
Rich Dad, Poor Dad, pay yourself first, all that stuff.
Yep. Another one, Mike Michalowicz, Profit First, talks about making sure that you as the business owner get paid first. And if your business can't even satisfy paying you first, why would you pay everyone else to then end up with nothing? So it's just changed that mindset that, you got to create something that allows you to get paid first and can then afford everything else. So yeah, definitely worth a look at both Rich Dad, Poor Dad and Profit First if you're new to us and haven't come across them before. So moving on from growth and opportunity, just another couple examples there. People want to do tax minimization a lot. They want to lower their taxable income. I don't want to pay tax. We get over the end of the financial year, and if we haven't had these growth conversations or what's next conversations, we get we get an email or a call from the team at Innovate, and they say, "Hey, Jace, what's the client's taxable income? They've just told us they want to buy a house." And it's like, great. Cool. Now, tax planning, that didn't come up, or for some reason these clients decline tax planning, and now all of a sudden their income is what it says on paper, and there's not an opportunity to really reshuffle things to show how the year actually unfolded. But these are the conversations. You might be wanting to buy a house, you might be wanting to put a shitload of money into super to set up a self-managed super fund and buy some commercial property. There might be other investment opportunities that you're looking into, but until you have the opportunity to look at what's happening next year, what am I trying to achieve? What's the growth of the business as well? Do you need to purchase a particular piece of machinery or asset or turn over some new cars? They're all things that need to be taken into account, that when you send that financials and tax returns to a broker, if things are done a certain way, it helps to, get the money unlocked to show the business is performing a certain way.
So important, mate. And we obviously see it.
Preaching to the converted there. I'm thinking every mortgage broker across Australia is going, I need a better relationship with my accountant. And there it is. It's like, work out where your client wants to go and where they need to go personally. Have a chat to an accountant, because preferably Jace.
Yeah. No, all good. And guys, look, won't try to bore you too much, and I hope you can see how important tax planning is and the excitement of it all that I have and my team have. We probably run about 300 meetings over 3 months at this time of year. Just really, it's our opportunity to get in front of our clients. We love it. And I haven't even scratched the surface of some of the things that come out of it, but I'll take you through just at a high level the agenda of the meeting, and then we can kind of have any closing comments. But effectively, we get in with our clients, and we wouldn't be numbers people without looking at the numbers first. So apart from the check-in that we do with our clients, they all fill out a survey, which allows us to conveniently capture information, which asks them these questions about what are their plans for next year? Do they want to invest in anything? Do they need new equipment? So we get all that off the way pre-meeting. Once we dive in, we're looking at the profit and loss. We're looking at the balance sheet. We're asking the clients if they're comfortable and aware with the numbers we're showing. Does it all make sense to them? Because a lot of the times business owners don't spend a lot of time looking at their own profit and loss and balance sheet. So it's a really good opportunity just to reset and say, guys, here's your P&L and balance sheet. Do you understand it all? And if not, it's an education opportunity. Just do that 101, how it's all connected. And sometimes you can see the cogs click and a client goes, oh, is that how that works? Like, thank you for showing me that. And because you don't know what you don't know. And we want these to feel educational and not like you're an idiot if you didn't know something. So it's all about making it comfortable. After that, we forecast the rest of the year and we tell you what your estimated tax payable would be if we did nothing. Just said, this is your year, there's your tax bill, done. Obviously, then that rolls into the conversation of that's what happens and you don't want any nasty surprises. So we preempt cash flow issues. We look at pay-go installments. Then we say tax minimization strategy. So there's heaps of different things, but the big ones are around prepaying expenses, bringing forward deductions that are genuine, pushing back some income that you don't need to bring into this financial year if there's a timing difference of income hitting in June versus income hitting in July. As an example, if you took $100,000 in June, you'd owe $25,000 sooner, so that'd be due by May 2026. If you're able to defer that income by a week and it lands in the first week of July, depending if you're accruals versus cash. But then all of a sudden on that $100,000 profit, if it's cold profit, that $25,000 tax isn't due until May 2027. So all of a sudden you've got some extra cash.
So just a question on that. So that would be for people who raise or have the ability to raise invoices. Are you just saying just push your invoice back a week? Don't invoice the client yet? It's as simple as that?
Depends on cash versus accruals. So if you're on a cash basis, you could still raise the invoice and have a conversation with your client and say, look, it's my preference that if you don't need to get that money out of your account, can you make sure you pay that invoice on the 7th of July? You'd set the due date for next year.
But the assumption there would be people probably want to pay you on the flip side.
Correct.
Prior to June 30 to get their own tax down.
And it is that juggle game of cash versus accruals and having a relationship with your customers and some of your suppliers to be able to juggle some of that. Writing off bad debts, obsolete stock. So stock on hand and stock movements are obviously sometimes a really big driver of what happens on your profit and loss and how much tax you pay. If you're carrying obsolete stock, but it's sitting in your inventory balance, let's say there's $100,000 of stock that could be written off. By actually moving that through the profit and loss and writing down your stock balance, you've just saved $25,000 in tax. And that's at company tax rate, let alone, in a trust or a sole trader. So again, if you're not doing these things before 30 June and not having these conversations with your accountant, I just gave a couple of really small examples, but you can think about what quantity of tax you can save if you were to pull all the levers available. Then we roll into super contributions. As accountants, we say what the tax saving of the super contribution is and what's their available amount. We don't advise from a financial point of view of what should or shouldn't be done. That's where we hand over to the lovely team at Innovate, who will talk to our clients about their financial planning and what they can do. But again, the example there, if you've got a carry forward cap, and we've seen this used, and you've got some cash, we've seen clients that are in the top marginal bracket decide to utilize their cap. And let's say hypothetically they put in $50,000 of additional super and they're in the top marginal bracket. That's just saved them $22,500 in tax in their personal name to make a tax deductible contribution to super before 30 June. So again, super contributions is one of the big ones. You'll always, if you do tax planning, it's probably the main big lever that accountants will try and pull to say, hey, chuck some money in super, we'll get you a big tax saving. But again, it all comes down to personal situation. If you are trying to build a deposit for a house, if you are trying to knock down, you want to put some money in the offset to not pay too much interest on your house, these things have an impact on how much money people want to then take out of their personal savings and put into their super as a contribution. But it is often finding that balance of what makes sense to put into super because I'm worried about or I'm conscious of building wealth for my retirement versus, I don't really want to pay that much into super, but I do want to save some tax. So last couple of points, really quick touch on trust distribution resolutions need to be done and signed before 30 June. Division 7A loans and loan management. If you have taken money from a company, need to put formal agreements in place. We'll review your asset purchases, look at depreciation, tax losses and offsets, Structure. Are you a company or a trust? Are you a sole trader? We review that and look at how we can restructure it. And we wrap up with general business and strategy chat. Plans for growth and expansion. How are your staff going? What are your pricing and margins? Any tech improvements? How's your AI plan? All those things. So, guys, I think I've given you a whole lot of what we do for tax planning. But yeah, I'd love to throw it to you guys if there is anything that jumped out at you or anything that crosses your mind.
Jumped out. I just go, like, people always complain about paying fees, but I'm going, I just listened for about 10, 15 minutes on the value that is provided with the right accountant. And it's astronomical. It's the same in financial planning. It's the same in mortgage broking. It's you don't know what you don't know, and that can cost you so much if you're not getting the right advice. But even there, it's absolute minefield, but you work through it beautifully. And I think every business owner is ready to just pick up the phone. It's incredible stuff. Well done.
Appreciate that, mate.
Yeah, and for me, I know we're talking about money and reducing tax and or at least minimising tax where we can and legally. But for me, I think the biggest value add is just peace of mind. And I think as a business owner, when you get tax bills or you have cash flow issues, it completely derails your focus and realistically, in the end, your performance. So for me, it's peace of mind knowing that you're doing everything right. You're not going to get a tax bill that you don't have the money to deal with. And then you can channel your energy into where you need to channel it, which is how to grow your business. So I think maybe the peace of mind, which is hard to quantify, but that's the biggest. That's the biggest takeaway.
It's massive,
for me.
Nick. Like, how many times, like, you're burning money in places you didn't expect in business. And a lot of that's around that type of lack of advice. And it's to get the right advice and know you've got the stepping stones to build a better future is incredible. So every business owner's been there. But again, don't balk at a fee when you're getting so much more value, probably 30, 40 times over. It's incredible.
I appreciate that. And sometimes, accountants across the country in Australia aren't sometimes good at describing the value that they're bringing and how much work goes on in the background. So, yeah, hopefully this helps to explain to business owners that tax planning isn't a nice to have, it's a must have before 30 June. And I really love what you said earlier on, Nick. If you're the business owner and you're not getting this, you need to drive this yourself. Like, take some responsibility, be proactive and get it booked in yourself now, or find someone who does want to be proactive for your business. So thank you for joining us. Follow, subscribe, click all the buttons. But until next time.
Numbers tell a story, but when Jace does it, it's really sexy. Game over.
This podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.